Welcome back, and you're watching Dukascopy TV. I'm Darren McDermott. I have James Marple on the line from TD Bank in Toronto to have a look at US consumer spending as it increased more than anticipated in October, as households bought a range of goods suggesting upside momentum in the economy early in the fourth quarter. Now, this is good news, and I'm sure we will continue to see an improvement over the next 2 months with the holiday season approaching. So James, what sort of figures are we expecting to see?
Okay, well, first, the retail sales report, this is an advance report. It also contained some revisions to the previous month. So going into October, you saw a little bit less momentum than we'd previously thought. But October was a good month, a good reading, especially considering that October was, half the month. You had the government shutdown, you had political gridlock. You saw that appear to take a toll on consumer confidence, but clearly it wasn't enough to dissuade consumers from shopping. So that's a positive, because that's where the potential impact was thought to be. I think in the months ahead, I think we should see a continued improvement. And one thing we've seen over the last several quarters is a relatively slow pace of consumer spending growth. In the third quarter, only 1.5% growth overall. I think that should accelerate in the fourth quarter, probably to around 2.5 or higher, and that's positive because that should lead to faster broad economic growth and of course job growth.
And despite demand picking up, inflation remains subdued. Why is this, and will it change soon?
Well, I think on the inflation front, we also obviously had that inflation data from October, and it was very soft. That, in large part, reflected declining gasoline prices. But the core rate of inflation is still pretty soft as well, just 1.7% year over year, even softer by other metrics, including the personal consumption expenditures price index. But I think there's still a lot of slack in the labor market. Obviously, the unemployment rate's still higher than it should be, and that tends to keep some downward pressure on inflation. I do think as the economy accelerates into the next year, as you see less fiscal drag, as you see more lending growth, more mortgage credit growth, and generally a rebounding housing market, that should start to lead to slightly faster inflation, moving, I think, slowly towards what is the Federal Reserve's target of 2%.
And what else will you be keeping an eye out for over the coming months?
Well, obviously the big report that we'd be paying attention to in a few weeks is the job report. The October job report was a little bit strange. You had the impact of the shutdown, a little bit of an increase in the unemployment rate, but that was probably temporary. You saw very good payroll growth, stronger than expected. So really looking for confirmation that the job market is still performing as well as it did in October, and trying to look through some of those discrepancies in the data. It's nice to get another month just to confirm or maybe cast doubt on what we saw in October. So that's the one that I think markets and we're certainly paying a lot of attention to.
James, thank you very much. Well, viewers, do stay tuned as we have plenty more coming up. See you soon.